Okay, this presentation in Colab Notebook is based off of student feedback. So I had some students chatting with some students talking about what I thought of the ARK portfolio. I think Kathy Woods, uh, whether in what I thought of their performance was a good thing to invest in and so forth. And my response was, uh, it's important to look at the if we're going to evaluate the performance, it's important to look at is the portfolio, is the ETF just taking on a lot of systematic risk and therefore should have higher returns, or we need to separate the risk taking from the basically from the stock picking to see is there really skill in the stock picking there. So that's why we created this notebook. I'll also, to answer that question, basically, is ARK outperforming that ETF? So, and this is also important. When anytime you're investing, it's important to understand is how much of your return is simply from taking risk, right? The idea here is if I take I can take a safe investment that's expected to earn 1% per year, and if I lever it up, right? If I borrow $99 for every dollar I have invested, then a 1% return will double my money, right? So the idea here is what proportion of your return is simply due to, so if I have 100% return, well, that's simply because I took a lot of risk, right? So this is an important thing to understand in your own investing is what part of my return is attributable to just the market going up, what part is attributable to basically the beta of my portfolio, and what part is due to actual stock picking skill. Last thing I'll say before we go on is what we kind of know from behavioral finance is the more skill you think you have, right, the more you'll trade. So definitely Wall Street wants you to think that you have a lot of skill, so that you'll trade more. But the idea here is you want to really understand, should you be trading, or is it better just to buy and hold the S&P 500 in a passive ETF? So what we're going to do in this notebook is we're going to download some data, we're going to construct a portfolio, and then calculate the Sharpe ratio, information ratio, and trainer ratio for our portfolio and some other portfolios. So to do this, what we're going to have to do is we're going to have to install the Y Finance library. So this is to download data. So and then SciPy to do a regression, Matplotlib to plot, so forth. So that's installed. We can go ahead and load these libraries. And what I have here is I'm defining now. Again, you want to interact with these notebooks, so absolutely, feel free to change these start and end dates. The idea here is what you'll find is when we evaluate portfolio performance, this can be highly subject to the time interval you choose. So you definitely change the time interval and see the effect on the sort of portfolio rankings. Often it won't change portfolio rankings, but particularly particularly over the last year with tech outperforming for such a long period of time, and then all of a sudden oil switching to the oil sector outperforming. So the portfolio performance evaluation can be, particularly in the last year, sensitive to these. So definitely feel free to change those. But we're going to use this start and end date, and we can go ahead and download the data from Yahoo simply with that call, which is great. It returns a pandas data frame, and we can take a look at this stock data right here. So what we have is Apple, Amazon, Boeing, General Electric, JP Morgan, Pfizer, Procter & Gamble, Tesla, Verizon, Exxon. But if you'll notice here, we have adjusted close. We should have open, high, low, and so forth. But we only want the adjusted close. So let's just pull the adjusted close prices. So now that we just have and I'll show you, we just have a data frame with simply the closing prices that we want. So this is perfect. Now, of course, we want to convert these into returns. So we can go ahead and calculate returns with this percent change from pandas. And then this, of course, gets rid of the first row. The first row in Python would be row 0. So this just gets row 1 onward because the first row will be, when you're calculating the percent change, will be an NA. So now we have stock returns. Now we have a data frame of stock returns. And I was thinking a little bit about how I want to construct the portfolio weights. I started writing this, but I don't really like it because I can't really ensure the order of this, and with certain operations, I'm not sure that the order should be maintained. But I thought maybe the best thing to do would be go with a dictionary. So here's a dictionary of portfolio weights. The idea of a dictionary is now I can just use a get function, right? And I can say get, and let's say Tesla, and it will return the portfolio weight for Tesla. So Tesla 10%, so 10% there. So now I can just make sure I'm getting the weight that I want. Of course, it's important to check maybe that your portfolio weights sum to 1, right? Doing the math in my head, that might mess that up. So summing to 1, of course, there's a little, this little tiny error is fine. This is just in the way computers store numbers. So it's never going to be exactly, 1. So there's a slight error, which is unimportant to us. And here, what I'm going to do is calculate the portfolio returns. So here we have a list comprehension. So I'm going to use that get function that we just used up here. And this is going to give me the weight. So this is going to be the weight for X in the stock return column. So I'm going to go over each column and get the weight for it, and then multiply it by the stock returns, right? And then sum over axis is 1. This is summing over the rows, right? So the idea here is I'm going to multiply the weight by the column, and then sum every row, and that's going to give me my portfolio returns. So we can go ahead and do that here. And then what I'd always recommend you do is just look at the data and ask yourself, does this make sense to you, right? Do these look like a portfolio returns, right? And particularly, does the mean and standard deviation look good? And I really highly recommend that you sort of get used to looking at the data, because one, if you make an error, you'll generally tend to see it here, right? You might catch your own errors, but also you get a feel for the data, and as you work 10, 20 years, this really becomes an advantage. And understanding the data and understanding the how to interpret the data and how to use it in the outputs and so forth. And as an example of that, why does this look normal? Well, we're using daily returns, and what you'll notice if you use daily returns is the mean is very small. It tends to be very small and positive, and it's absolutely dwarfed by the standard deviation. So as you look at a short time interval, the variability far outweighs the sort of thing we can predict, right? So that's a hallmark of the shorter and shorter time intervals. However, if I were to use yearly data and then maybe look at decades, right, then the mean becomes much larger and more certain. So the idea here is if we look over a long time interval, so it's decades or years, and what we're going to see is a mean return for the market broadly of like 9% with a fairly small, a smaller in proportion standard deviation. So the idea here is the shorter time interval, the standard deviation becomes larger with respect to the mean. The longer the time interval, the mean becomes larger with respect to the standard deviation. So as we look longer and longer, we're more certain of the return that we're going to get. So when I look at this, I go, okay, those look perfectly like portfolio returns. It's a very, very small mean, and then dominated by a large sort of amount of randomness. Good. So this is our portfolio. We're going to compare our portfolio with SPY. This is the Standard & Poor's S&P 500 ETF. This is ARK. So this is one of the ETFs by Cathie Wood. XLEs, energy, financials, gold, and NASDAQ. QQQ. So we'll go ahead and pull the ETF data, and we'll go ahead and calculate returns and look at the ETF returns. And again, we generally tend to see the same thing, small means, larger standard deviations, right? So you see that is, again, not, it's not our portfolio. This is just indicative of what stock data looks like over daily stock returns. So we're going to put all of these into one data frame. So the idea here is we're going to take these portfolio returns, put them in a data frame, and then we're going to go ahead and merge them with, so here's our portfolio, right? And then we're going to merge it with the ETF returns. So now we have all returns where it's the ETFs and then our portfolio over here. Good. So let's calculate the Sharpe ratio. So the Sharpe ratio I have, well, actually I don't have the equation in here. So this is just going to be the mean return minus the risk-free rate divided by the standard deviation. And what I'm going to do here is I'm going to annualize it. So the idea here is we're keeping all our sort of, it's very common to report the Sharpe ratio annualized. So what I'm doing here is this is my risk-free rate. This will be my annual risk-free rate. And then what I'm going to do is I'm going to calculate I'm going to annualize. So when we annualize returns, right, we multiply by 252 days in the year. When we annualize the standard deviation, if we were to annualize the variance, then we multiply it by 252. But if we're annualizing the standard deviation, we multiply it by the square root of 252. The standard deviation is the square root of the variance. So so we can go ahead and do that. This is just to show what the annualized returns look like, and we do see ARK is much higher than the others, right? Particularly, what I'm really interested in is comparing ARK to QQQ because those are kind of the most similar. And this is, what the standard deviations look like. So here we can go ahead and calculate the Sharpe ratio. So this is the annualized mean return minus the risk-free rate divided by the standard deviation of the portfolio. So once we do this is going to do it for each column, right? There we go, and what we see is ARK has a Sharpe ratio of 3.48, which is the highest. Gold, I usually say don't buy gold, and that's true here. QQQ, again, sort of the most similar portfolio, and this is showing the outperformance of tech over the period. QQQ has a Sharpe ratio of 2.0, SPY a little bit less than that, actually closer than I would have expected. Energy underperforming, financials performing fairly well. And look at our portfolio. Our portfolio was second only to ARK. And I kind of randomly chose my portfolio. That's not to say randomly choosing a portfolio is better. It just happened to work out in this case. And I obviously chose big names, Tesla. And I think this is simply a look-back bias because I put Tesla in there, which had done very well. So this is just probably a look-back bias on my just picking things that were off the top of my head. But so what this shows is ARK does seem to outperform. Now let me interpret the Sharpe ratio here. So this is what we'd interpret this as this is your return, right? The numerator here is your return. What we call this your return in excess of the risk-free rate. So so this is your return per unit risk. So the standard deviation here is our measure of risk. That's not the only measure of risk. That happens to be the one that we're using, the Sharpe ratio. But what this ratio is doing is saying this is our return per unit risk. So if we look at all of these portfolios, ARK provides us the largest return per unit risk. So this is supportive of, I think this is Kathy Wood. I think that's a portfolio manager. This would be supportive of Kathy having being able to choose stocks well, right? To be able to outperform the market, right? So this is definitely supportive of stock picking skill on the behalf of whoever's running the ARK portfolio. So again, the way we interpret the Sharpe ratio, return per unit risk, and ARK is outperforming. So we do have other measures. So now this is your return, right? And this is just your total return, your total excess return, right? So, and this is your total risk, right? So this is kind of like total return per unit risk. But what we can do with other measures is look at, so if we look at something like the information ratio, this is our alpha. Now this is return beyond what we would predict from something like the CAPM. So this is our alpha divided by the unsystematic risk. So this is just, it's not the total risk. This is just the risk that we can't explain by movements in the market, right? So the idea here is, and I'll go over this in a second, but the idea here is we're still looking at kind of return per unit risk, but now it's our return not attributable to the market divided by risk not attributable to the market. And this is called the information ratio. So to calculate both the trainer and information ratios, we're going to have to run a regression, and we're going to have to get the outputs of this regression. So using SciPy, right, what we're going to do, now this is a lambda function. This is an anonymous function. I'm not sure that we've seen this before, but what we're going to do is we're going to apply this lambda function over all columns here, right? It's going to return for each of those the slope, intercept, R value, P value, standard error. Again, this is the standard error of the slope coefficient and so forth. What this is going to do is it's looking at our all returns. It's going to feed in our all returns data frame and apply this lambda function to each column. And this lambda function, unnamed function, right, anonymous function, is going to estimate a regression of that column's returns on SPY, right? So we can go ahead and estimate that, and again, kind of looking to make sure that everything is as we would expect. What you'd expect is SPY to have a slope of 1 and an intercept of 0, because you're regressing SPY, and SPY should throw an error, but so this looks good. If we didn't get this, then this or an error, I would be suspect. And again, looking at the output ARK, we would think it has a beta coefficient greater than 1, which it does. Gold has a beta coefficient less than 1, so everything sort of looks good here. Our portfolio is slightly higher beta. Good. So what we can do is we can use these to calculate our information ratio and trainer ratio. So going here to our information ratio, remembering that this standard error is not the standard error of the residuals. We have to go and calculate the residual standard error. That's what we'll go ahead and do here. So we have our observed values for ARK, then we're going to have our predicted values from the regression. So this is just the slope coefficient times the SPY returns plus the intercept, right? And then we calculate our errors here, and then take the standard deviation of the errors. Right, calculating our residual standard error here, and then we can calculate the information ratio for ARK, and our information ratio is 0.18, and then we'll calculate the information ratio for our own portfolio, and let's see. Oh, I see. Yep, I see my error here is our error should be our observed. So I forgot to put in the hour, so pardon me here. So this is our, meaning our portfolio. And this should be our error. So that should now work. Good. And now again, we want this to be as high as possible, because again, the numerator is our alpha and the denominator is the standard deviation of the unsystematic risk. And lo and behold, ARK has a higher information ratio. So this is additional evidence that of the stock picking skill of ARK's portfolio managers. And again, definitely change the time intervals and see if you get similar results. For your exercise, go ahead and calculate the trainer's ratio. So what trainer's ratio is again, this is our excess return. This is the return on the portfolio, average return minus the risk-free rate, divided by the amount of systematic risk in the portfolio. So in the Sharpe ratio, we divided by total risk. Here, we're only looking at systematic risk. So this is return per unit of systematic risk. So go ahead and calculate trainer's ratio and see if ARK outperforms here as well. Have a great day.